Good morning from London. I'm Anna Edwards alongside Tom Mackenzie. We're an hour away from the opening trade. Here's what you need to know. Getting closer. Fed Chair Jerome Powell says a September cut is on the table. After the central bank holds rates again, focus now turns to the BOE with its policy decision on a knife edge. It's one of the busiest days of the earnings season in Europe. We will bring you all of the numbers and analysis. This after big tech bounces back with Meta's upbeat results. Plus, oil extends gains on a New York Times report that Iran's supreme leader has ordered a direct strike on Israel in retaliation for killing Hamas's political chief in Tehran.
So, Anna, we tie in, of course, the oil story. We focus on the geopolitics, but also, of course, the earnings and digesting the decision from the Federal Reserve to stand pat, but open the door wide open, according to our own live team, to that first cut in September. We look ahead to the BOE and that decision, which we know is finally balanced. European futures pointed to gains of 0.3%. The tech story is well pronounced yesterday in the US session. FTSE 100 future pointing higher by 31 points. Brent up at 81.52, gaining 0.8%. And the Japanese yen and the strength coming through, 149 as a Mundi eyes 140 potentially in terms of the Japanese yen, and we've seen that weigh on equities in that country, currently gaining 0.2%. The countdown to the opening trade starts right now.
The question will be whether the totality of the data, the evolving outlook, and the balance of risks are consistent with rising confidence on inflation and maintaining a solid labor market. If that test is met, a reduction in our policy rate could be on the table as soon as the next meeting in September.
If that test is met, says Jerome Powell. Good morning, everybody. So we have earnings everywhere we look this morning. But we will first focus in on what the market learned last night from the Federal Reserve and look ahead to the Bank of England. So we'll start with the macro and then, Tom, dive into the micro because there are plenty of micro stories to cover. On the macro, the Fed's Jerome Powell there setting out the conditions that could lead to a rate cut in September. I thought it was really interesting, this new focus on both sides of their dual mandate. So they're attentive to both sides of the dual mandate, not just highly attentive to the inflation risks, which is what we'd had the previous time around.
They have greater confidence in terms of getting back to that 2% target, but as you rightly point out, underscoring what they're seeing in terms of the relative cooling in some parts of that labour market. Unemployment remaining at 4.1%. A question for some is if they see the data that they see now, why didn't they act yesterday? The argument may be that that would have smacked of panic, so the rate remains at between 5.25 and 5.50. But as our MLive team have been saying, the door now is wide open to that September cut for the Fed.
Absolutely. So we focus in on September for the Fed. We focus on today for the Bank of England. Last time I checked the work function, a 57% chance of a cut. So that's speaking to what we said in their headlines. It could go either way here. But there is some expectation that we get a 5-4 vote split this time around in favour of a cut. That versus 7-2 last time around. We'll get further analysis on inflation and GDP from this central bank this morning. Into the afternoon. So that's where we are on the macro stories in terms of the central bank narrative, the Fed and the Bank of England in focus. Let's get to some of the earnings news. We've got Shell out this morning, Tom. Maybe we should focus there, announcing a share buyback of $3.5 billion.
Yeah, this is the redhead crossing the terminal right now. Shell announcing that buyback then, $3.5 billion, pretty punchy in terms of the buyback programme. Adjusted second quarter profit coming in well above the estimates, $2.3 billion US dollars. The estimates had been for just shy of $6.3 billion US dollars. The estimates had been just shy of $6 billion. So a comfortable beat in terms of second quarter adjusted profit. Announcing the buyback. We know that this is a company more focused now on the oil and gas components and shifting a little away from renewables. But again, it's the buyback and it's the beat on the second quarter. And we're going to be speaking, of course, to the CEO later in the show.
Yeah, we will. Let's move to Barclays. We're also getting numbers out of Barclays this morning in the banking space. Investment banking revenue has come in just a shade above estimates, £3.02 billion against an estimate of £2.89 billion. And I go to that line because it's the red headline across the Bloomberg, but also because there was a real focus on investment banking revenue coming into this quarter and what that would deliver. Also a focus on net interest margin trends and any kind of buyback. And we are seeing a buyback here. And this looks to be, as expected, a share buyback of up to £750 million. That was what the market was looking for on the Barclays front.
And very briefly on the supplements and medicines maker, Haleon listed here in the UK A modest beat in terms of the first half revenue coming in at £5.7 billion, just above the estimates, just marginally above the estimates. In terms of organic revenue, also coming in essentially in line at 3.5% in terms of the increase, and saying that they are well positioned to deliver on their medium-term guidance. We're going to be speaking, of course, to executives and the head of that company coming up very shortly. In terms of the tech earnings, that was pretty fascinating as well. There's been a lot of scrutiny in terms of the spend. We know this. It had impacted Microsoft, impacted Alphabet. Meta coming through, they're still reiterating they've been spending very heavily on AI, but it was a beat in terms of the ad sales, and part of that is driven by the fact that they are integrating this AI to make some of these efficiencies and make this targeted ad sales a little bit more profitable for this business.
Yeah, that seems to be the name of the game. And Mark Zuckerberg, we heard him yesterday even making jokes about how other CEOs just talk about AI all the time on the calls, and he made no apology for talking about AI all the time on his call. There were other things in mention, and the stock went up after hours. Also, sticking with the tech theme, worth a mention of ARM. This stock did not go up after hours. There was no increase in guidance, and that seemed to be what the market was disappointed with. Yes, the data centres is a positive story, but this is a chip design business that supplies a host of sectors, and on the other side of it, we've got autos and industrials, and other chip companies have flagged negatives around those sectors.
So the softness in the EV market reading across to ARM, and of course this is a company that still is central around the smartphone story, and we know smartphone has been in a little weak as well. They've been making a big play around AI, but for the moment a little bit of concern on ARM. We look ahead, of course, to Apple later today and Amazon.
Apple later today. Nvidia certainly in focus after that 7% drop on Tuesday, and then a 13% climb in yesterday's session.
Whiplash.
A bit of the Fed in there, of course, but also some of the other earnings stories we've had out of the tech sector. A lot of volatility in tech. Plenty of earnings interviews coming up for you then. Shortly, we'll be speaking to Brian McNamara, the CEO of Haleon. Tom's just been through some of the numbers we got there. At 7:20, we're joined by the London Stock Exchange Group CEO. That's David Schwimmer. Jerome Grivet, the Deputy CEO of Credit Agricole, joins us exclusively at 7:30 a.m. for a conversation. Then we'll speak to Belén Garrido, the CEO of Germany's Merck. That conversation at 7:35 this morning. Later this hour, 7:45, the Shell CEO, Wael will be joining us on the programme. And at 8:45 a.m, we will talk aviation. Joseph Aradi from Wizz, the CEO of Wizz, will be with us to discuss.
OK, here's what else to watch out for today then. This Thursday, very busy, of course, in the earnings front, the macro front as well. 10 a.m. UK time, Euro area unemployment rate. After we got some CPI and growth data out of the Eurozone, that will add the mix in terms of building out the story around the health of the Eurozone economy. 10 a.m. UK time, we're also going to be getting the OPEC Plus meeting at a time, of course, where we're seeing oil up above $81 a barrel right now on Brent, on what is happening in terms of the tensions around Iran and Israel. And 12 p.m. UK time, of course, it is the Bank of England's rate decision. We'll be all across that story for you with the interview as well coming up later in the day with Andrew Bailey. And at 1:30 p.m. UK time, we're going to get US initial jobless claims, which of course ties into Anna's point about the focus now of this Fed on the labour market of the US. So that will be fascinating on the back of that decision. And later, those earnings then from Apple and Amazon and what they are doing around AI inevitably will be the focus, and also ConocoPhillips as well within the energy space. Here's what else you need to know this morning. The New York Times reporting that Iran's supreme leader has ordered a direct strike on Israel for the killing of a Hamas leader on its soil. The threat comes after Iran and Hamas said Israel assassinated the group's political leader in an airstrike in Tehran. Oil, as we mentioned, extending gains in late trading following that report. Republican nominee Donald Trump has questioned Vice President Kamala Harris's black identity at a contentious roundtable with black journalists. Trump responded to a question about GOP attacks, casting Harris as a DEI hire, referring to diversity, equity and inclusion. Harris is the daughter of Indian and Jamaican immigrants. The White House condemned Trump's comments. And Bloomberg has learned the US is considering more restrictions on China's access to AI memory chips and equipment as soon as next month. The measure is designed to keep Micron Technology and South Korea's leading memory chip makers SK Hynix and Samsung from supplying Chinese firms with so-called high bandwidth memory chips.
A lot going on in the chip space then, Tom. We talked about chips a lot yesterday, and those moves in ASML quite stunning. We'll certainly keep the chip sector in focus then with that story in mind. Let's get back to some of the other earnings stories, though, this morning. Tom went through some of the headlines coming through Haleon. We should just mention also starting a buyback programme of up to £185 million and updating guidance from this business. So let's start there in our conversation with Brian McNamara, the CEO of Haleon, who I'm very pleased to say joins us around the desk. Thank you so much for coming in, Brian. Really nice to see you. Let's start with the guidance and the message you're trying to get across to investors. You see full-year organic revenue 4 to 6% higher. The estimate was 4.75%. So does this sound as if you're guiding the market a little higher in their expectations?
Well, first, we had a really good first half of the year, and I feel good about those results. So 3.5% organic sales growth in the first half, 4.1% in Q2. So we saw momentum in the business. Operating profit growth of 11%, so ahead of sales growth, showing margin progression, strong cash flows. Net debt is down below 3 at 2.9. And importantly, 69% of the business maintained or grew share. We feel really good about that. So that resulted in our confidence to confirm our 4 to 6% sales growth guidance. We feel very good about that, and upgrade our profit guidance to high single-digit growth from just ahead of sales growth.
OK, so some upgrades to various parts of the P&L, it seems. In terms of returning money to shareholders, you're starting this buyback programme. You've got a figure on that. And tell me a little bit more about how that fits in with the overall strategy to return money to shareholders. How do you think about that?
Yeah, so if you look at our capital allocation priorities, it's invest in growth, bolt-on M&A, return excess cash to shareholders. In February of this year, we announced that we would do a £500 million of buyback this year, given the confidence we were in our cash flow and the fact that our net debt had gone down to 3 times leverage. We did $385 million of that as part of the Pfizer placement that happened in March. And now we've announced that the additional $185, we're going to go into the open market imminently and start that buyback.
Brian, good morning. You talk about bolt-on acquisitions then, bolt-on M&A, as part of that mix. What would you be looking for in terms of adding to the portfolio?
Yeah, so first of all, we love the portfolio we have, but I think any portfolio can benefit from a continued evolution. And part of that can be divest, and part of that bolt-on M&A. So we've divested 3 brands now in the last year. And bolt-on M&A, we have a very clear view of our brand market combinations and where we think we have opportunities. And we're interested in doing bolt-on M&A, and we'll do that as soon as we feel like there's something that strategically makes sense for the business, adds value for shareholders, and we'll continue to proactively manage the portfolio.
As you think about the consumer then, in a more challenged environment, and of course you have an upgrade coming through, but in terms of the move, arguably some are seeing a little bit of sensitivity from consumers in the US, here in Europe as well, and the move away from the big name brands, your brands, to own label. Are you seeing that come through at all?
Yeah, in the categories that we compete in, and in consumer health, we're seeing a pretty resilient consumer, actually, and I think part of that is in health. It really matters to consumers. Health really matters, and brands in health really matter. So we're seeing pretty good resilience across the portfolio. Take, for instance, the U.S. Business, where it's a big private label business. Overall, in our business, we're actually growing share versus private label. Now, it's not in every brand, in every category, but overall, we're not seeing any material impact on the business. And I think that's a testament to the brand strength, and the categories we compete in.
Picking up on that, Brian, you've embraced a premium brand strategy then, according to some of the analysts we were reading this morning. I wonder, to Tom's point about consumers and consumer strength, has that been tested at all with consumer strains? Cost of living crisis is the way we describe it in some markets, but the rate of inflation that we've seen and the cost of living in certain markets over recent years.
Yeah, I think, first of all, it's an unprecedented time with inflation and areas like that. I mean, fortunately, in our business, we're a bit less exposed to commodity-related costs. So if you look at the pricing that we've taken on the business over the last year, certainly we needed to cover those input cost increases, but it hasn't been as high as many of our competitors. So we've been very focused on balancing the pricing, trying not to get out ahead of the consumer and continuing to see volume growth.
But some consumers have faced higher prices for other products.
Yeah, absolutely.
And so therefore, do you find it? Are some of them tempted to do those trade downs?
Yeah, again, very volatile. To date, we haven't seen those trade downs. So we've seen real resilience in the portfolio, and I think the market share gains that we've seen, and the continued top line growth and the volume growth we've had in Q2, I think is a testament to that.
We know that EM, emerging markets, key in terms of future growth for Haleon.
Yeah.
How are you looking at positioning around that? How is that story unfolding? What are you doing to maximise that potential?
Yeah, we see tremendous opportunity in emerging markets. So overall, 35% of our business is in emerging markets, 65% in developing markets. China is our #2 market, and we're quite optimistic, actually, on the outlook of China. India is a market for us that has consistently grown in the strong double-digit range. We also have strong presence in places like Middle East, Africa, and Latin America. So it's really a key part of our growth.
So what specifically are you doing to build out in some of those countries?
Oh, absolutely. So that's about meeting that consumer's needs. So we do have a lot of initiatives around more affordable products in those markets. So, for instance, in India, Eno is a very big digestive health brand. We offer a 10 rupee pack, basically a 10 pence pack, that is distributed throughout India. So we're seeing lots of opportunities on that affordability because that consumer is trading up to the middle class, getting to them at an early time where they become brand loyal, they use our brands, they see the benefits, is a real benefit for the long term for us.
Thinking about, it's a very busy year for politics in many places, and I wonder, being a business that is based here in the UK, whether you have any thoughts on what you'd like to see, the business environment you'd like to see, policy changes you'd like to see from the new Labour government that we have here in the UK.
Yeah. And we're based here in the UK. We compete in over 100 countries, and we see all kinds of leadership changes and government changes happening as we speak, and we're happy to work with any government that's in place. Listen, I think there's a real opportunity to drive more growth in the UK, and we think consumer health, everyday health can be a part of that, and we're excited to work with the new government to see what role we can play.
OK, Brian, thank you very much. Thank you for joining us. Brian McNamara, the CEO of Haleon. That just kick-starting one of our earnings conversations this morning. We will discuss the earnings picture and the outlook for the UK listings environment with the London Stock Exchange Group CEO, David Schwimmer. That conversation coming up shortly. This is Bloomberg.
We are around 40 minutes from the opening trade. Welcome back. Happy Thursday. European futures flat. US futures, though, pointing to a brighter session, up 0.4% on the S&P E-minis. We're focused on central banks. We're focused, of course, on the earnings story. And right now, we bring you another great guest on that front. Let's bring in David Schwimmer, CEO of the London Stock Exchange Group, with the beat coming through for the LSE Group. David, good morning. Thanks for joining us. Talk to us about the earnings story then and how it pushes the company forward in the quarters ahead. And also give us a sense as to whether or not the IPO pipeline is coming back. What's your sense?
So strong performance, strong first half for LSEG with our revenue up 7.6%, and it was a good broad-based performance, growth from all the different parts of the business. In terms of the IPO pipeline, it's looking encouraging and continues to improve. But in terms of our business, we showed improvement in our operating margin, up about 50 basis points, and that's while we continue to invest across the business. So that's been a strong performance there, and a lot of innovation, a lot of new product. Our partnership with Microsoft is going very well. We will have commercial availability of new product in this half. So feeling really good about the business and a lot of momentum.
OK, no, we definitely want to get to innovation. We definitely want to get to your partnership with Microsoft, really important for the business going forward. But talk to us about the deal making and in a bit more detail, David, because we have seen, of course, this flurry of private equity deals in terms of rich pickings across the UK space. How much of a threat is that momentum that we're seeing for PE to the LSE?
So this notion that private equity buying companies is a threat, I don't think captures the full picture. I think it's part of the natural ecosystem that we have. You want companies to list, go public, grow. Some of them will stay public. Some of them will be acquired. That's all part of the natural evolution of the system. I think the reason that this narrative has picked up over the last couple of years is that on a global basis, there has been a pretty light calendar in terms of IPOs. But that's, I think, due to a lot of other things, whether the macro environment, some of the geopolitical instability. So, as I said, the IPO pipeline's looking encouraging, and as you get that IPO pipeline coming back, it'll be seen as sort of the natural ebb and flow in the markets. Companies go public, companies get acquired, and that's how it should work.
Your business, you talked about the deal you've done with Microsoft. David, good morning to you. And clearly you have high expectations there. I wonder if the recent issues, and I know this was a CrowdStrike issue, but turned into a Microsoft issue, whether that gave you pause for thought on that particular relationship.
Doesn't change anything in terms of how well the partnership is going and the opportunity that we have to build product together. I think that it's important for the whole industry to be thinking about single points of failure and risk management. But in terms of our partnership with Microsoft, we're really excited about what we're doing in terms of embedding our workflow, our workspace functionality into Microsoft Teams and 365, in terms of putting our data sets into an integrated cloud architecture so that that can be distributed more easily and more efficiently. So lots of good things going on in our partnership with Microsoft.
Okay, so confident on that. We've seen some proposals, changes to regulation, FCA rules being updated, all with the intention of trying to rejuvenate the City of London if it's lost its way a little bit in terms of attracting those listings. Do you think those measures are material enough? Do you see anything new coming from the new government on that front?
So I think all of these initiatives are helpful, and all of them add up incrementally to making the environment that much more attractive. And I think we've seen resolution of the political uncertainty. We're seeing resolution of some of the economic uncertainty. We'll hear from the Bank of England later today. But I think the capital markets reforms that you're referring to also very helpful. And the FCA has been working on these for a couple of years. And these are the biggest changes to the listings regime and the market regime here literally in 30 years or so. So that is only helpful, and it makes London that much more competitive and that much more attractive as a listing environment. I think there's more opportunity to continue to do more. The FCA just last Friday announced more reforms, some that are in final rules with respect to research, and then there's another consultation on some of the prospectus regulations. So there's more coming. And then on top of that, I think the government continues to focus on pension fund reform, which is a big one. And can have the opportunity to bring much more capital into this market and have a much more effective use of the huge amounts of capital that are in the UK pension sector but have not been consolidated in the way that would use them most effectively.
David, talking of consolidation, is there a case that the environment has changed in terms of potential consolidation between exchanges? I cast my eye back to 2017, Deutsche Börse, LSE, of course, and that was nixed by regulators. Has the environment changed in terms of potentially big deals within this sector?
So I wouldn't speculate on anything related to us. If you look across the sector, I think there could be some consolidation in terms of some of the other exchanges. I think some of the regional exchanges may be thinking about that on a regular basis. But it's hard to speculate on that, and I think some of the politics around exchange consolidation would probably continue to be pretty challenging.
David, are you disappointed that, I know you don't want to talk about individual issues perhaps, but the prior government had a plan to do a big marketing campaign around a NatWest retail offer? Looks as if we might not get that. Are you disappointed if we don't get some kind of focus on retail shareholding in the UK that might have generated?
I think there's an opportunity to improve the investment environment for retail. I think some of that is being considered by the FCA in the latest set of reforms that I was just referring to. I think some of that is about investor education, and I think there is more to do in terms of making this environment really attractive for retail participation. I think there's also a healthy discussion about risk appetite, risk culture, and a recognition that in the capital markets, sometimes you make money, sometimes you lose money. And that's another important aspect of this.
David, thank you very much. Thank you for joining us. David Schwimmer, the CEO of LSEG. Thanks for being with us. Coming up on the programme, investment bankers outperform at Crédit Agricole. Our exclusive conversation with the Deputy CEO of Crédit Agricole, Jerome Powell, standing by to join us shortly. This is Buyback.
Welcome back. 30 minutes from the start of the opening trade this Thursday. Here's what you need to know. The focus, of course, on the earnings front. European futures are flat, but do not let that fool you. This is an exciting day for these markets. As we look ahead to the BOE, we digest, of course, the decision from the Fed, and we work through all of these earnings. European futures flat. US futures, though, pointing to gains of 0.5%. Let's get to the earnings story then and break out what's been happening in the banking space, because we have seen some positive results. We turn to a French lender right now. Crédit Agricole's second quarter profit beating estimates as traders and deal makers outperformed, and the lender began to see the delayed benefit of higher interest rates in France. Very pleased to say we are now joined exclusively by Jerome Rivet, the Deputy CEO of Crédit Agricole. Jerome, thank you for joining us. To what extent is the momentum going to carry things forward on the trading front? Is this a one-off, or is the momentum going to be sustained when it comes to the upside from your trading team?
Yeah. First point, keep in mind that trading activities is a significant business for Crédit Agricole Group, but it represents only around 10% of our net revenues. So it's an important area. It's a business in which we help our customers, corporate customers, to finance their investments. But it's only, I would say, quote unquote, around 10% of our revenues. Definitely, this is an area in which we've been improving a lot over the last 5-6 years, and we have definitely a position vis-à-vis our customers that is improving regularly. And so I guess that the results we're posting again this quarter are not a one-off. It's definitely our status to be in the top tier of the big investment banking when it comes to FICC trading activities.
And of course, you've benefited from that higher interest rate environment, but now rates are moving. Now rates are moving lower. The markets expect rates to be below 3% by the start of next year across the Eurozone. How are you positioned around a lower interest rate environment?
Well, actually, we are not betting on the rates. Our job is to be here in order to help our customers to raise the funding that they need on the markets. And so, of course, when rates move in upwards or downwards, it may change a little bit the behavior of the customers. But definitely, our job is not to take positions vis-à-vis rates. And so we're, to a certain extent, agnostic when it comes to the level of the rates that is beneficial for us. What is important for us is clearly the appetite of our customers to engage into financing operations.
How has the political uncertainty of France impacted the business, Jerome?
Well, definitely in June, there has been some volatility on different markets related to the event of the call for the snap election decided by the President of the Republic. But the volatility on the market has significantly eased since the final results of these snap elections. And to be frank, the political uncertainty may change a little bit going forward, the conditions under which we operate, but it doesn't change our business. And our business will continue to be here, whatever the changes in the political life in France. So it creates some uncertainty, but again, it's uncertainties related to the conditions under which we operate. It doesn't change the nature of our business, and it doesn't change our business model.
A few of the analysts out there have expressed concern that maybe costs and expenses will be a risk for the business going forward. How do you see expenses evolving in the quarters ahead?
Actually, in the last quarters, we've been we've had some impact of the inflation environment in France and in the Eurozone. And so we have had to grant general salary increases, which is not normally our policy. We are now back in an environment where inflation is very close to this 2% target. So we are back in a normal environment where we have individual salary increases in the beginning of each year, and we have no other I would say, pressure on the cost basis. So we are going back to a more normal cost environment, which is a good news, definitely, and which is proving actually that the stance taken by the ECB in the last 2 years to really curb inflation rapidly was right.
OK, interesting in terms of a more normal cost environment. Can you give us an update, Jerome? There's been some reporting that you're in talks, a potential takeover, SocGen's German consumer finance business, Hanseatic Bank. Can you give us an update on that? How close are you to getting that deal over the line?
We never comment specific M&A operations. What we think is that in the field of M&A in Europe, there might be some consolidation in different specialized businesses, and actually we are indeed taking part in this consolidation in specialized business lines. Just as a few examples, recent examples that we can comment is the fact that we've started to integrate the private bank Degroof Petercam in Belgium in the last quarter, and indeed we have in our numbers 1 month of Degroof Petercam in June, and we've also acquired a Swiss asset manager that has been integrated in the perimeter of Amundi, again in the course of the last quarter. So we are participating in M&A operations when it makes sense for us, but we of course never comment potential operations that are not confirmed.
OK, we'll get that scoop from you another time then. Jerome Powell, Deputy CEO of Crédit Agricole, thank you very much indeed on the earnings coming through for the beat with that lender, of course, with the investment bank outperforming.
Thanks to Jerome for joining us this morning. Let's pivot from French banking over to the German corporate space. And Germany's Merck says its semiconductor business has reached a turning point amid the AI boom. This, as the global pharmaceutical and chemicals company, gives more details after raising guidance last week. I'm pleased to say we're joined now by Belén Garijo, the CEO of Germany's Merck. Very much appreciate your time, Belén. Thank you so much for joining us. I want to start with some detail around what you're saying on semiconductors this morning and on your electronics division. You're talking about an AI-driven boom. I wonder if you could give us some more context around that. Is this a semiconductor boom that you've been expecting for a while, or is this a step change, something more AI-driven? How excited should we be about this change?
Good morning, Anna. We are very, very pleased to have landed a very strong quarter, and in that quarter we have materialized our commitment, the commitment that we announced earlier in the year of returning to growth. Definitely, semiconductor materials has been the main driver of growth in the quarter, and yes, indeed, this is related to the inflection, the market inflection that we have seen in both artificial intelligence and advanced nodes. So we are convinced that the adoption, the progressive adoption of artificial intelligence is going to drive growth of this business, because actually the participation of artificial intelligence in our current material business is still very low. So artificial intelligence represents only 10% of the current revenues of semiconductor materials. And when you look at the devices, it's even much lower. So it's only 0.7%, around 0.7%. So we are very confident that the progressive adoption of artificial intelligence will continue to drive this market.
OK, so Belén, as a result, I want to ask you if there's upside risk to your estimates. Could we see an upgrade to guidance? Now, I suppose if you thought that the results would be better, you would be saying so today. So I wonder if you can give me a sense of how predictable are the numbers that you're going to achieve in the electronics part of your business then?
So, as you noted, we have raised our guidance last Friday based on a very strong performance in Q2 and our view of our 3 business sectors, not only electronics. So we are very confident that the progressive inflection point in electronics, beyond what I mentioned, artificial intelligence and advanced nodes, in which we have already seen the uptake, will help us continuously deliver growth in the coming quarters of 2024. And this is, once again, not only for electronics, but we are also very confident with our healthcare guidance and with the expected progressive development of our life science business in the coming quarters.
Yes, on the life science business, I want to ask you about that because there's been an issue with destocking in that sector, and so the recovery of this business has been predicted for a long time. Are you already seeing evidence that this destocking is coming to an end? What are the dynamics you're actually seeing at the moment within that business, Belén?
Indeed, we have, through our close contacts with our customers, as well as our quarterly surveys on the way the stocking is progressing, we have already seen some major customers normalizing their stock levels, and we are expecting this to continue, and therefore we are really confident that the stocking will come to an end around the end of, the beginning of Q3, and therefore we will definitely progress in accordance to the normalization of inventories at our customers' level. We have tons of transparency on the way this is happening, and once again, we are confident that we will be delivering on guidance also for life science.
You've mentioned the upgrade to guidance that you gave, Belén, and you talked about good numbers in various parts of the business, including healthcare. But you've been dealt a couple of setbacks in the healthcare space recently, whether that's cancer drugs or multiple sclerosis. I wonder how concerning for the outlook for the healthcare business those setbacks are.
Healthcare is a super performing business at this time. They have delivered growth, not only in this quarter, but in former quarters, very highly profitable growth. We are operating on very attractive margins, and we are expecting healthcare to continue to deliver. Now, for the midterm, obviously the setbacks that we have seen in our pipeline will encourage us to accelerate our business development activities in order to continuously increase the optionality of our pipeline and position healthcare for long-term growth, profitable growth. This is exactly what we are going to do. Our capital allocation strategy has not significantly changed, and our priority remains life science, but we need to continuously in-license new assets in order to be able to replenish our pipeline in phase 3.
Belén, thank you very much for your time. We appreciate it. Belén Garijo, the CEO of Germany's Merck. Coming up, we'll move on to the oil sector and to energy. Oil giant Shell announces a $3.5 billion share buyback plan. Chief Executive Wael Swann joins us next. This is Bloomberg.
Welcome back. We are less than 15 minutes away from the opening trade. The focus, of course, on the earnings story and Shell coming through with a beat, announcing a $3.5 billion share buyback and reducing its debt by around $2 billion as well in the quarter. Very pleased to say we are now joined by Wael Swann, CEO of Shell. So, Wael, good morning. Thank you for joining us. On the buyback then, $3.5 billion. RBC, before these results, one of their analysts came out and said you could raise that buyback to $4 billion. Are you being overly conservative on the return of cash to shareholders?
Thank you for the opportunity this morning. What I'd say is we have actually announced in June of last year that we wanted to go on what we called our first 10-quarter sprint, which just drove the fundamentals of the company to become much stronger. Lower cost. We have now announced $1.7 billion of cost takeout, more capital discipline, improved operational performance, all allowing us to continue to be able to indeed enhance shareholder distributions. We've talked about 30 to 40% of our cash flow from operations going to distributions. And you're right to say that we are with the $3.5 billion. We've been approaching the higher end, if not slightly above the 40%. And what we continue to focus on is consistency of delivery. This is not about simply one quarter after the next looking at what we can do from a distributions perspective, but looking through this period and continuing to make sure that we are able to reward our shareholders consistently at the higher end, while continuing to moderately deleverage and invest in our businesses. So overall, we like the balance of where we are at the moment.
Do you like the balance of the mix, though, in terms of the upstream doing the heavy lift, the downstream looking a little vulnerable, refining margins still a little soft? Well, is the business vulnerable if oil moves low? You've benefited from $85 barrel oil over the quarter. That environment could change.
It's fair to say that we have seen, in essence, normalization of prices and margins across the energy system back down to pre-2022 levels, whether you're talking refining margins, whether you're talking LNG prices, even power prices. We are building a company that is actually resilient to the low side of the oil prices as well. And that's critical for us. We create value through the cycles. And what we have done is by taking out some of our costs, by really focusing on the capital discipline, we believe that we have an organization, a company that is able to continue to buy back shares to as low as $50 oil price. That puts us in a good situation. Our balance sheet is the strongest that it has been in a very, very long time. And our fundamental business model continues to work. While indeed we enjoy the upside during high commodity prices, it's important to recognize our marketing business particularly performs really well when you see commodity prices go down. And of course, we have the world's leading trading business, which also allows us to take advantage of those volatility moments. So by and large, we like this model we have of a multi-energy vector company that allows us to be able to win in today's energy system, but also importantly, to continue to win in the lower carbon energy system of the future, of which we are committed to play our role.
Wael, you talked there, good morning to you. You talked there about the resilience of the business down to $50 a barrel in terms of the oil price. Clearly, there's a lot of focus on whether we see a higher oil price from here, partly perhaps driven by geopolitical tensions. We haven't necessarily seen prices come in as high as they could have done since the most recent bout of Middle East tension. What are you braced for? What do you think could happen on oil prices as a result of this geopolitics?
Very difficult to predict. It's fair to say that at the moment we see that the physical markets are well balanced, if anything slightly tight, in particular on crude going into the summer season. We saw stock draws all across the world, except for China. I think the biggest determinant of where prices might go is a combination of, indeed, as you mentioned, geopolitics, but critically OPEC's decision in the coming weeks around the pace at which it unwinds its cuts, and of course the Chinese demand. Of which there are mixed signals at the moment. And so what we try to do is to focus on what we can control. And what we can control is everything from our own cost structure, our capital discipline, our operational performance, and the portfolio choices we make. We want to make sure that we are allocating our capital in the most responsible way we can.
OK, and so with that in mind, Wael, you might not like this question, which maybe you think is something you can't control, US politics. I wonder what's at stake there, though, because you do have to think about these things even when you can't control them. LNG markets in particular, do you see the US LNG landscape shifting considerably, dependent on whether we have a Harris or a Trump administration?
We don't see major shifts in the short to medium term. These projects that are being talked about would only come, which are being held at the moment, would only really sort of start up towards end of this decade, early the next decade. And so for the next 5 to 6 years, whatever is in the funnel and already sort of under construction will be what comes into the market. But indeed, as I've said in the past, the biggest issue is the LNG market, like any other energy market that looks at long-term fundamentals, requires stability, requires consistency, requires predictability. And any major policies that start to rattle investors in those big infrastructure projects can potentially undermine confidence in that market, which I think would be a real miss given the incredibly important role that LNG in particular will need to play in the energy transition, both from an energy security perspective, but also from an energy transition perspective for coal to gas switching.
Are you getting that? Are you getting that reassurance here in the UK? The new Labour government raising the windfall tax on energy players here. What is your response to that move?
Look, we've invested for a long, long time in the UK, and in successive recent governments, what we have seen is changes to the overall framework for the energy system, for the energy investment. The number one thing we look for when we look to invest, given the nature of our investments, which typically are long-term investments, multi-decadal investments, both, by the way, in the conventional energy space as well as in the new energy space, what we look for is fiscal and regulatory stability. And anything that potentially destabilizes that, of course, is not welcome. And so what we continue to do is to engage constructively with the government to be able to clearly express our views and then to respond to the signals that the government chooses to put into place.
Have you already been engaging with the government? Wael, what are the early signals you're getting?
We have been engaging with the government for several weeks now, and we expect continued engagement in the coming weeks. I continue to hope for a balanced approach, recognizing some of the challenges that the incoming government is trying to deal with. But at the same time, what we can do from a Shell perspective is to advise on what are the key ingredients of an investment climate that will be conducive to the sorts of investment that are able to support any government as it's thinking about its energy policy. We've said to many governments we are willing partners in their efforts to establish energy security and decarbonize their energy grid, as long as it makes sense from a strategic perspective for us and as long as we see the stability that is required.
Wael, thank you very much. Thanks for joining us. Wael Swann, the CEO of Shell. Well, a lot of earnings conversations this hour, Tom. A lot of corporate earnings to digest. Futures actually pretty mixed this morning, or at least FTSE futures suggest we could see some upside, downside elsewhere.
Yeah, really strong session overnight on Wall Street, but the handoff to Europe has been a little soggy, down 0.4%. We unpack the earnings story, the impact across the markets, of course, with the opening trades coming up this Thursday in a little under 6 minutes' time. Stay with us. This is Bloomberg.
A few minutes to go until the opening trade. Welcome back to the programme, everybody. So, Thursday's session about to get underway. 2 minutes until we do get underway. We are bracing for what that delivers us, as you can see on the right side of this chart. This is yesterday, though, and the handover. This is Europe, sort of on the rise and then treading water, losing a little bit of steam. This is the US, coming in pretty strongly, maybe losing some steam. But I feel like the after-hours story in the United States around tech also in focus, because, of course, we saw a lot of tech strength within the session, some of that driven by the Fed commentary, the likes of Nvidia really flying in yesterday's session, but that after weakness the previous day. So tech in focus in session and then afterwards as well, with those numbers coming through from Meta, but then there was ARM, so conflicting signs around the tech space. This is the futures picture for Europe then. FTSE futures up by 0.4%. We've got Euro Stocks 50 futures down by 0.5%. And it seems some of that weakness could come through from the French market, so that's going to be an area of focus for us, Tom. Getting a sense of where we head here, a day after the Fed, as we wait for the Bank of England, working our way towards that central bank decision. This is the mixed futures picture we have here in Europe.
Yeah, so we lift the hood. A big earnings day, of course, so we focus on companies like Shell coming through with that $3.5 billion share buyback, saying that the market is either balanced in terms of oil or a little tight. The CEO talking to us, of course, just a few minutes ago. A beat coming through in terms of the top line on the earnings from Shell and that share buyback. Also looking, of course, at VW. Different picture there in terms of a miss coming through for that German automaker. The exposure to China is a challenge. And Barclays coming through with a beat as well. And the CEO looking at £1 billion worth of cost cuts. So we watch that company on the back, of course, of a earnings beat coming through from Barclays. Anna.
Yeah, absolutely. And a buyback story from a number of those corporates this morning. So that could be something that underscores the positives, cash generation and returning cash to shareholders. But on the other hand, some of the guidance may be leaving a little to be desired on some of these European corporates. And certainly that's been a theme through the auto space. But we know that already around China weakness and around EV sales, removing of incentives and what that's done to the margins of some of those automakers. So could be a mixed bag today. The FTSE 100 then out of the gates and actually pretty flat this morning. We will be looking to see whether a higher oil price and that performance around buybacks can lift some of the energy names in London. The FTSE 100 now up by 0.1% this morning. The FTSE MIB in Italy down by around 0.5%. The CAC 40, as expected, underperforming, down by around 0.7%. We've had numbers out from the banking sector, of course, but they didn't necessarily look as if they would lead to negative trading stories. So we'll see where that negativity on the CAC 40 is coming from. The IBEX down by 0.2%. And the Xetra DAX, with those auto names in focus then, Tom, still to open. What do you see if you take a deeper dive into these markets?
It's a big day for the UK. It's a big day for the UK, of course, on the earnings front, but also with the BOE and expectations that possibly they could go for the first cut of the cycle. The FTSE 100 is the outlier amongst the major indexes right now, with gains coming through of 15 points, up 0.2% on a sector-by-sector basis. Part of the reason for that upside coming through for the FTSE 100 is a lift to commodities, oil as well as the earnings story. Basic resources, your top sector right now, gaining 0.6%. Food and beverage also gaining 0.4. Telecoms up 0.4%. It's a mixed picture, though, in terms of the split coming through across these sectors, because on the downside you have media and banks, despite the gains coming through from Barclays in terms of the earnings story, and also the French lenders performing well, as was ING. So beats coming through for the financial sector, but banks as a sector currently down 0.6%. What else is standing out to you at this point, Anna?
Yeah, just having a look at the CAC 40 then, and where the points are being lost, and it does seem as if it's a continuation of the luxury story. So LVMH is one of the biggest decliners on a points perspective, that and L'Oreal, and this another day of negativity then surrounding that side of the business. The banking sector actually pretty mixed. So we have Crédit Agricole on the rise, up by 1.4%. BNP Paribas, though, down by 1.1%. So we are seeing perhaps a bit of rotation there within the French banking sector. But it is that luxury space that seems to be weighing on the CAC 40 today, and, you know, a continuation of that theme.
More soft data out of China, no doubt tying into that story. In terms of some of the individual names, we talk about Shell, of course, with the buyback, and the shares up 0.7% so far in the session. You mentioned Crédit Agricole, a beat there in terms of the earnings story as well, up 1.6% so far on Crédit Agricole. Barclays, just checking the pricing that come through, because it was a beat in terms of net interest income, and of course coming through with a buyback story there as well. So Barclays up strongly right now, up just over 3%. VW on the downside, though, down 2.5%. Certainly the exposure to China also hitting the German automakers. And, of course, the question around slowing demand for EVs, but it's the China impact on VW, down 2.3% on the back of the miss from their earnings. OK,
so that weighs on what's going on in Germany, and we're still waiting for the DAX to open, in fact, I think. The CAC 40 then down by 0.8%. I've mentioned luxury, and that is a big points driver to the downside today, but also the banking sector. I mentioned the BNP Paribas is weaker, but actually it's SocGen that's been driving that, down by 5.6% today. We had numbers out of Crédit Agricole. That stock is up by 1.5%, but SocGen down by as much as 6.9% actually out of the gate, but just regaining a little of that poise after those second quarter results coming through from that particular bank.
Yeah, pretty interesting in terms of what's happening with SocGen, because it was a beat in terms of the top line when it came to their earnings. So income from trading equities, of course, that key unit of SocGen, jumping 24% to just shy of €1 billion in that quarter, the 3 months to June. That beat the estimates. So the downside coming through on the stock right now, we'll have to understand why that is and what's leading to that caution. We know the French retail bank has been a challenge, so they cut their guidance for interest income there. So that was some softness. But in terms of the trading story for SocGen, that was actually a beat. But as you say, the stock down currently 5.1%.
Yes, we're seeing the CFO of SocGen speaking on a media call right now, so we could get some further clues about performance there. Let us get to the core six, shall we, Tom?
Yeah, luxury is part of the core six, of course. Let's bring those up for you and see how they are shaking out. The tech story as well, with ASML in focus. Some more detail around potential additional restrictions when it comes to the US and semiconductors, particularly focused on AI into the Chinese markets. Novo Nordisk currently up, 0.6% as I strain my eyesight. LVMH, though, on the downside, as Anna flagged. Luxury taking a hit. That's weighing on the CAC 40, down a full 1% as things stand. Ferrari down 0.4. ASML, there's the story there in terms of the key maker of those lithography machines, actually seeing some gains of 0.7%. Tech got a big lift in the US session yesterday, and there's the pop coming through from Shell, up 1.5% on the earnings beat and the share buyback. OK,
let's get an update on some of the more detail behind these individual stock moves. Joe Easton joins us from our equities team. Joe, good morning. And you start with the auto sector.
Absolutely. So did want to start on the auto today because it's a clear weak spot on the European market, led by Daimler Truck. This company gave guidance after the close of trading in Europe yesterday, and analysts calling for 15% downgrades to consensus earnings. They are seeing weak orders across a number of regions today, but it's not just Daimler Truck. Tom mentioned BMW earlier, falling on potential China weakness and EVs as well. And Volkswagen lower too, given some weakness in their EBIT margins. All three of those big German car makers falling today. And that is why we saw a delayed open on the DAX index as well, as traders were adjusting to that. A clear weak spot on the market today. The other sector, though, is the banking stocks. You mentioned the Barclays move. There it is, up 3%, a 750 million buyback, pretty much in line with expectations. But the investment bank, better than expected in terms of their earnings, around $100 million more than analysts were looking for. ABN AMRO coming off 1.7%. The CEO stepping down surprisingly, and SocGen continues to slide. Tom touched on a few points there with the retail business, the net interest margins all in focus. I didn't expect it to be down as much as that. Down 6%. Credit Ag, the rival, going the other way, up around 1% today, looking pretty strong on their retail business. In fact, in terms of a couple of UK earnings to bring you, there's a lot out today catching my eye. Well, I mean, we've got to look at that Rolls-Royce move, up another 10%. That's one of the best performing stocks across the European market over the past few years, and once again raising its cash flow. But just at the top, you mentioned Shell opening up 1.6%. There is a buyback there, $3.5 billion, similar to what BP did in terms of the money they are returning. Next, the UK retailer jumping 6%. They're actually saying that their guidance was a little bit more cautious because last year they had a big jump in sales following some really strong weather and a return after the COVID bounce that we saw. But Rolls-Royce, that one really standing out. BAE Systems had results from Aeros as well, but I can't take my eyes off Rolls-Royce. Really an outstanding stock in terms of the UK aerospace firm. There are yet more earnings, too many to get through, really. We'll be glad to see the back of this morning, won't we? But AB InBev up 2%. Bud Light slightly rebounding after the sales kind of issue that they had with the influencers over in the US. That one is rebounding a bit today. Vonovia over in real estate getting a big bounce. That's Germany's largest real estate company. And Heidelberg giving a bit of negativity, down 2%, a bit of weakness over in construction. But I've had enough of earnings. That's too many earnings. So we're going to do something different. We've got a very small company in the UK, and I'm glad we put that in there because it's up 18%. Novo Nordisk investing a small amount of cash in a company called Oxford Nanopore Technologies in the UK. It's on the UK small cap market, a 20% jump, just showing what Novo can do. I think we're going to bring up Wizz Air. We're going to do something different. I've just been told in my ear we're going to look at Wizz Air because this one getting hammered, down 14%. That is after cutting their forecast for profit, according to a statement today. That's the biggest decliner I think we've got in the UK. Wizz Air bringing us back onto earnings, down 14% this morning.
Joe, thank you very much. Joe Easton from our equities team. We will be talking to the CEO of Wizz Air shortly, so we'll get further into that story, talk about where we are on the aviation cycle, access to aircraft, supply chain issues, of course, very topical there. We will return to all of that. We also need to keep on our radar, Tom, the fact that we have a Bank of England rate decision taking place today. We pivot off the Fed, where they, in the words of John Authers, did nothing and committed to nothing. But still, it was a big story for markets. Today, with the Bank of England, you know, they might actually do something. We might actually see this cut.
Arguably, the BOE is more interesting. Not more impactful, of course, globally, but arguably more interesting in terms of just how finely balanced this decision is. So, like, markets fully expecting that there's going to be a cut, but there's a mix in terms of the views from economists out there, and markets pricing at about 50 basis points, so two cuts by the end of this year. And they're going to come out of their forecasts around inflation and growth as well. So there's going to be a lot to unpack. And there's a mix. There's a change at the top in terms of the MPC as well, which adds to that uncertainty. And we haven't heard from many members of the MPC. So there's a lack of information going into this decision as well, which is why I think there's some excitement.
There is a bit of excitement, yes, because we haven't heard from the team at the top, of course, because of the election. There was a sort of self-imposed, to some degree, purdah that took place there. And then Claire Lombardelli is the first time that she's going to be voting, so that adds some unpredictability to it. So could we see this 5-4 vote for a cut? That does seem to be where the market is putting its focus. But then it is kind of on a knife edge, as we've been saying this morning. One thing that has been interesting is that services wages component, that's still elevated. And some of those in the services sector still trying to push those costs onto consumers. And the Taylor Swift effect in hotels, that was something we actually saw coming through in the last set of inflation data on the UK. So certainly a lot to talk about when it comes to the Bank of England. And we'll have special programming on that front.
Can the services inflation data shake it off? She's back, by the way, in August. In terms of the pound, there's the pound lift as well, 128. So the pound has been very strong in the last last few months, and particularly in terms of the gains that have come through versus the US dollar. So what it means for the pound and that inflation input as well, because stronger pound helps in terms of our import of all those energy costs and commodities and other components. So stronger pound is helpful in terms of reducing inflation, but does the pound wobble if we start to get a cut in terms of the guidance as well from the BOE? So that's a big one. I'll have Lizzie Burden on the ground outside that central bank covering all of that for us. To technology next, though. Coming up, Meta's AI investments. They may be starting to pay off. More on the company's upbeat earnings report next. This is Bloomberg. Welcome back to the opening trade. 14 minutes into today's session, the Thursday session. European stocks, the benchmark down 0.1%. US futures, though, pointing to build on the gains of yesterday, and they were pronounced. Currently, S&P E-minis pointing up by 0.5%, and the Nasdaq the Nasdaq 100 ended up more than 3%. Nasdaq futures pointing to further gains in the session of 0.7%. The earnings, of course, continue to roll in, and part of that Nasdaq gain was coming through, of course, from some of the big mega cap tech names. And after hours, the story around Meta, because their shares jumped on the back of better than expected results in terms of the sales, particularly around adverts, and displaying the evidence that AI is helping to sell more targeted adverts. CEO Mark Zuckerberg spoke on the earnings call.
It's hard to predict how this will trend multiple generations out into the future, but at this point, I'd rather risk building capacity before it is needed rather than too late, given the long lead times for spinning up new infra projects. And as we scale these investments, we're, of course, going to remain committed to operational efficiency across the company.
OK, joining us now is Matt Bloxham, tech analyst at Bloomberg Intelligence. And Matt, we focus on the ad business and the AI spend. Have Meta found a sweet spot now where they're spending heavily in terms of the AI infrastructure, but they're also seeing a lift in terms of integrating some of that technology and improving the ad sales environment?
Definitely a sweet spot, but I think there's a much bigger sweet spot they need to generate to justify those huge investments they're making. I think that's what we heard a little bit from Mark Zuckerberg, that this is the kind of mid to long-term story. They need to make these investments, but really we're just scratching the surface right now about what this technology is doing for their current platform and how that platform is going to evolve over the mid to long term. But as you said, we saw slightly better than expected revenue growth, a bit of a different mix. So you kind of got ad impressions, so how many adverts they're serving to their users and how much each of those ads cost the brand. And what we saw was a slightly slower rate of growth in the ad impressions, but a stronger pickup in the revenue per ad. So they're kind of delivering, I guess, fewer ads, but they're much higher quality. Ads are prepared to pay more for the targeting they're getting, and that's because of the AI technology they're integrating into the platform. So definitely some kind of progress there. But it's kind of really interesting what he said about the huge amount of money they're spending on AI technology. They need to spend this now so that they're in a strong position and they're not kind of behind the curve. And I think that's kind of helping companies like Nvidia for sure. OK,
so that's what's boosting Meta. That's the AI story there. Something to do with AI, no doubt, boosting Nvidia yesterday,
yes.
Matt. But what on earth is going on with Nvidia? I mean, down 7% one day. So we take that as the context for the 13% rise yesterday.
Yep.
But for any company to add $329 billion in market value in one day is pretty epic.
It really is.
And
I mean, I think it's more than coincidence that Mark Zuckerberg spoke so much about AI and this fact. He said that we're probably going to look back in 10 years and say, yeah, we invested way too much money in 2024, 2025 on AI, but we had to because everybody was. This is an arms race, an AI arms race, and if you don't spend the money now, you're going to not have a strong position in a mid-term view. So I think, and given that Nvidia is clearly still the kind of prime beneficiary of all these investments, my gut feel is that's what we're seeing, the read across that, yeah, OK, this investment cycle is going to be sustained into next year and they're going to be a big beneficiary of that.
So today we switched the focus to Amazon and Apple. What are you going to be looking at there? What is the preview around those two companies?
So I think for Apple, it's really about this return to revenue growth. They had a few kind of, quite weak quarters, and so the market's looking for not much, but like maybe 2 or 3% revenue growth. iPads is the kind of big quarter-on-quarter driver of that incremental growth because of the product launch, but people are also expecting to see iPhone sales, which are roughly 50% of overall revenue, perhaps not return to growth, but certainly not be down double-digit year-on-year, so maybe kind of a low single-digit decline. And obviously people are looking for any commentary they make about the iPhone 16 launch in September and how excited they are about the volume uplift from that. And on Amazon, I guess it's all about the cloud. That's where they make most of their profits, and whether they're kind of going to follow what we saw, the weak results from Google and Microsoft last year, that corporates are spending less in the short term on technology projects, and is that dampening the cloud revenue growth, or are they gaining share?
Matt, thank you very much. Matt Bloxham of Bloomberg Intelligence with the latest on the tech sector. We need to talk about some of the autos. Worst performing sector on the stock 600 today, Tom. We've had a drop in margins at VW and a drop in margins at BMW as well.
Yeah, so the sector as a whole down 1.6%. VW being hit as well in the session, down 2%. And part of that is down, as you said, to the margin squeeze and what is happening in terms of the Chinese market as well, as investors, at least consumers, I should say, rein back in terms of their spending. And we know there's been very aggressive price cutting. That's hitting margins. The competition as well domestically, a real challenge.
OK, so the competition is a challenge. The Chinese story, selling into China, is a challenge. EV sales in Europe and in the United States, a well-documented challenge. We've heard this from Renault, from Stellantis, from Nissan. There is, to some extent, many parts of the auto sector wrestling with some of the same issues. What self-help measures, then, can companies within the auto space deliver? Our attention then turns to costs. So we asked the Volkswagen CFO, Arno Antils, about what the company can do on costs.
We don't start from scratch, obviously. We already communicated that we want to reduce our overhead costs by 20% by 2026. We stopped hiring. We decided on an early attrition program. We worked on the plants already. We initial productivity measures. We reduced some of the expensive night shifts in Germany in several plants, Wolfsburg, Emden and Zwickau, and other things. But it becomes very clear we have to step up our cost work because competition is increasing, as you said, and the focus area should be even more focus on the fixed cost side, fixed cost reduction, even more focus on productivity measures in the plant. And thirdly, we can use even more synergies within the group. These are the things we look at and the areas.
And one of the things that I've been looking at, and you as Chief Financial Officer of Volkswagen no doubt also have been looking at, are the labor costs, which are obviously a huge part of this cost operation. And we have them sort of on the average in Germany, they're 62 euros an hour, France, 47 euros an hour, Belgium, 46. Then you go down to Hungary and it's closer to 16 an hour. The market has been clear about what it wants. It wants cost discipline. It wants a company that runs leaner. Obviously, you have a lot of stakeholders, and there are the unions. My question to you is, who is going to win? Is it going to be the market, or is it going to be the unions, or is there a compromise that needs to be made somewhere in between?
I think at the end of the day, everybody acknowledges that only companies that are competitive can basically secure in the long run also jobs. So this basic understanding is clear. And as said before, we work on productivity measures. We work on all retirement programs. So we will reduce our overhead costs by 20% by 2026. So these measures are agreed on. But as said before, we need more measures on that type. And I think the understanding is clear.
And one of the measures that I know you guys are looking at and maybe don't have news on today is closing this factory, this Audi factory in Brussels. And when Volkswagen talks about doing something like that, we take it seriously because you've never closed a sort of factory in Europe before. So for Volkswagen, but also I'm asking you as someone who knows the economics of automaking better probably than anyone in the world, not just for Volkswagen, but for the rest of the auto sector in Europe. Are there going to be, do you think, more factory closures over the next few years? Are we the beginning of something that's really changing the paradigm in Europe?
Yes, we look at the situation in Brussels. We started the communication and progress there according to the Brussels law. But as I said before, there are also other measures. For example, in Wolfsburg, we took out some expensive night shifts. Look, if you take out a night shift, you reduce basically capacity by 30%. So we communicated on our capital markets today that we will reduce our capacity by 10% in Europe. We adapt basically our capacity to the European market. Pre-COVID, we saw 60 million cars. Post-COVID, we have 40 million cars. So that puts a lot of pressure. And by now, also, the whole industry worked down the order backlog that stems from the chip crisis. So that increases competition, and we act accordingly. But we have also other measures in place. I give you one example. Today, we have great products on the MQB. Golf is produced in Wolfsburg. Seat Leon is produced in Spain. Skoda Octavia is produced in Eastern Europe based on the same platform. And we move in the future to a completely different concept. So we will bundle all the cars on one platform in one factory. So that also will get significantly positive effects from us.
OK, that was the CFO of Volkswagen, Arno Antlitz, speaking to Oliver Crook. And if there's one message you took from that interview, it is his focus on costs, and cost discipline. Currently, the stock down now 1.9%, close to 2% on VDW so far in the session. And the auto sector is weighing more broadly on the DAX. And it is the biggest loser in terms of your sectors. On a very different note, though, Rolls-Royce seeing some gains. This stock, by the way, up about 160% in the last 12 months. So Rolls-Royce rallying in the session, up around 9%, as you can see right now. This as the company lifts its guidance. And the cost discipline is helping this company, certainly. Raising its profit guidance for the year, said it's going to reinstate dividend payments for the first time since the pandemic. That demand for aircraft engines and power systems really benefiting Rolls-Royce, Anna.
Yeah, that's interesting. We're going to come to Wizz in a moment, aren't we? And a very different story coming out of Wizz. So different dynamics, very apparent within the aviation sector. Let's talk about banking, though, in Paris, because Paris continues to underperform. The CAC 40 down by 0.7%. And part of that is being driven by the SocGen share price, which is down by 5% this morning. We had news earlier on, some earnings news out of the business. And whilst the overall second quarter did seem to beat estimates, that was very much thanks to trading revenues, which outperformed Wall Street, and that sounds all great. But it seems to be the retail performance, the domestic French retail performance, that is disappointing investors right now. And as a result, we see that stock on the back foot.
I still find that surprising. All the analyst notes about these French lenders said the retail elements, the retail units in these banks are likely to be soft. So the fact that this wasn't priced in is interesting. Wizz Air, though, switching focus to the airlines space. As you mentioned, your flag when you're speaking to the CEO as well. But this stock taking, wow, look at that hit, down almost 13%. And the details coming through from Wizz Air, cutting its net income guidance then for the full year, Anna, missing the average analyst estimates. It now sees net income of 350 million euros to 450 at the top end. That's down from a previous guidance of up to 500 to 600 million. So downgrading its net income guidance for the full year, and investors obviously retreating on the back of that.
And this has been due to the availability of aircraft and having to ground some of their aircraft during that busy summer period to try and address holes in the schedule. Then they've been leasing aircraft, and you could either lease them with crew or without crew. And it's expensive to do it with crew, of course, because you're looking for everything to just be there ready for you when you want it. That's what they've been having to do. That's cutting into profits. And so a lot to talk about with Joseph Ferrari when we speak to him shortly. So the Wizz Air CEO will be with us a little bit later on in the programme. We'll also continue to focus in on the Bank of England. We have a Bank of England rate decision. It hangs in the balance. BNP Paribas Markets 360 reckons we will see a 5-4 vote in favour of easing. That does seem to be a fairly wide expectation. We'll hear from their senior Europe and UK economist, Matthew Swann, will be with us shortly. We'll also be looking for an update on inflation and growth expectations from the Bank of England. So just what do we expect? This is Bloomberg. Welcome back to the opening trade. We're 30 minutes into today's session. We see European stocks just on the back foot, down 0.2%, being weighed down by luxury and the banking sector over in Paris. The CAC 40 down by 1%. The FTSE 100, the only one of the major markets, just keeping its head in the green as oil prices head higher this morning. Now, markets are pricing a more than 50% chance that the Bank of England will vote for its first interest rate cut since the start of the pandemic. Our UK correspondent Lizzie Burden joins us from outside the Bank of England for a preview of today's decision. Lizzie, talk to us about why this decision is so uncertain, because the market isn't quite sure what to expect today.
No, you're absolutely right. Markets are on a knife edge, and economists reckon it's going to be a 5-4 vote split, so extremely tight here. The reason that they're in the dark is, first of all, because we haven't heard from the Governor, Andrew Bailey, since May, because, of course, the election got called, so we've been in a quiet period. You've also got an unknown entity on the Monetary Policy Committee in the form of Claire Lombardelli, voting for the first time as Deputy Governor. But, of course, on top of that, you've also got a mixed bag for economic data. Yes, headline headline inflation is back at the 2% target, but beneath that, services inflation came in hotter than expected last time. Although if you strip out the Taylor Swift effect on hotel prices, strip out the volatility, actually it looks like services inflation is coming down. So it is quite a confusing data picture, but if they don't take this opportunity to cut today and explain themselves with a press conference and updated forecasts, you could see inflation rising again before the end of the year, and actually they missed the window to cut today.
Lizzie, after the grim, frankly depressing speech from the Chancellor, Rachel Reeves, earlier this week about the outlook for this UK economy, the challenges, it'd be quite nice to get a cut today, wouldn't it? Talk to us about the politics of this BOE decision.
Yeah, Rachel Reeves really painting a bleak picture and rolling the pitch so that there is the groundwork in case she needs to raise taxes in that October 30th budget. But look, you had lots of Conservatives really angry at the previous Prime Minister, Rishi Sunak, for calling that election the last time we had the inflation numbers come out. They said that, you know, why would you call a snap election and hand Keir Starmer the first rate cut? Let's see if he gets it today. But you could have quite a bit of an awkward moment for Keir Starmer in the form of those updated forecasts if the Bank of England's officials see long-term growth potential in the UK economy below 2%, when he's actually targeting 2.5%, and he's relying so much on growth to relieve that choice between tax rises and spending cuts. Another difficult moment today potentially for the politicians could come from an update on asset sales. We weren't expecting one until September. We were actually expecting them to slow the pace from £100 billion a year. But increasingly, after a speech from Vicky Supporter at the BOE last week, you've had economists saying that you could see the BOE maintaining the pace or even accelerating it. And because the Treasury covers the losses, that would add to the fiscal headache for Rachel Reeves on October the 30th.
OK, UK correspondent with the details, Lizzie Burden, outside the Bank of England, who will be covering all of this for us throughout the day. Of course, the biggest, most important meeting of the year, of course, for the BOE. Let's get more details, more analysis, and bring in Matthew Swann, senior Europe and UK economist at BNP Paribas Markets 360. And Matthew previously served as monetary policy advisor at the Bank of England. So we tap that deep expertise, Matthew, and your past at the BOE. Do they go today, and what do you expect to see from the guidance?
So, in short, yes, they do go today, but it's going to be a close call. So, we're looking for a 5-4 vote. And if we go back to June, I think we saw the committee begin to split into 3 groups. Those who are already voting for a cut, those who see the decision in June as finally balanced, and then those who are in the remainder. And it is those that are finally balanced that we think will tip into a cut this time. Why do we think that? Well, we've seen headline inflation as they forecast, pay growth as they expect, and unemployment a little bit higher than they expect. So we think all the conditions are there for them to cut. In terms of guidance, well, we don't expect to get anything too firm. We think they'll go down a sort of ECB data dependence. But we do expect them to emphasise that rates will remain restrictive for some time from here on in.
Where do you think the market pricing is on this? Are markets getting it right in terms of expectations, how they building positions across the gilt markets in expectations of how the BOE sequences this?
So our view is a little bit different from the market. So we're expecting 3 cuts over the course of this year. Why is that the case?
So the markets are not pricing in enough yet in terms of the easing from the BOE?
That's what we think. And in particular, we think that might come across in the Bank of England's projections as well. If what we expect the Bank of England to show this time is that inflation at around 1.5% in 3 years' time, based on a curve that ended sort of a week on Tuesday ago. It looks quite similar to today. So we do think that might be an implicit suggestion that there is a little bit more easing needed. And we think September might be the case because we think it's clear that bank rate at the moment is very restrictive, and you can more safely go sequentially at the start of an easing cycle and keep things in restrictive territory.
What about the underlying picture around inflation then, Matthew? What do we see there? And given that you used to have close dealings with the MPC, and you'll know how they're thinking about inflation. With that in mind, how do we think about the services inflation component, which has been higher than had been desired, I suppose, by the Bank of England?
Yeah, I think there's really 2 things to think about here. The first is that it is now seemingly less important than it was. So if we look back to June, the Bank of England really de-emphasised services inflation, whereas prior to that, it has sort of been their primary indicator. So it is now one amongst equals rather than the most important in our view. The second is the Bank of England were very clear that the overshoot in June, which was 40 basis points, is in part due to past inflation and in part due to volatility in the data. And they particularly mentioned hotel prices. And they have been strong again in the June print, perhaps reflecting the sort of controversial Taylor Swift effect.
OK, yes. You say controversial. We didn't linger enough on Tom's really bad joke earlier, which I thought was excellent, actually.
Bad but excellent at the same time.
Bad but excellent all at the same time, as many jokes are. The one
Yeah.
about, you know, shaking off the services inflation effect. Anyway, just to nod towards Tom's excellent sense of humour. So that's the inflation story. And then what about on the growth side of things? Are we going to get some kind of upgrade to GDP? Are you expecting the Bank of England to want to signal that to the markets? Because then it sets up an interesting dynamic. If you upgrade growth expectations, but then you also cut interest rates, you wonder what that tells us.
Yeah, I think it's quite a subtle story here. So we are expecting an upward revision in growth, particularly in 2024. And the subtlety comes because we don't expect them to change unemployment. So all else equal, it's stronger productivity growth. And that is something the Bank of England can handle without having to keep rates stronger. It's not inflationary. So it's a good news story there. It's stronger productivity growth, a similar inflation forecast, and therefore the Bank of England can cut at this meeting.
Wait, so productivity
Yeah,
growth
sorry,
is
yes.
it's finally,
Let's linger on that
it's
for a moment,
it's finally
shall we?
coming back to the
Sounds
UK.
like the Holy Grail.
That's the headline. Wait, how is that your projection, and what would be fueling that uptick in productivity? We've been looking for this elusive elixir of growth in the UK for, over a decade?
At this stage, I think it's far too early to say this is a sustained effect. There's a lot of volatility in the national accounts data and the GDP growth data. So we have seen a rebound in productivity over the first half of this year, that's for sure. It's very hard to tell. Productivity is notoriously hard to predict. You can just look at the last 20 years of forecasts to see that, and it's very hard to predict where it'll go this year. But the strength in growth is something the Bank of England have shown they're willing to look through. If we look back to their previous minutes, they're more concerned with what they think is underlying growth, and that's sort of what they derive from the business surveys. And we think that's around 0.25%, and that's what we've seen to date.
Okay.
So we think on the growth side, the Bank of England will be happy and willing to cut.
OK, we got very excited about productivity, and you're kind of poo-pooing that for the moment.
For now.
For now. So there's the caveats around that. Talk to us about the fiscal response from this very constrained new Labour government, and that was articulated by the Chancellor earlier this week, Rachel Reeves, of course. How are you thinking about fiscal and how that couples or not from the Bank of England's position?
Yeah, so obviously we'll get the full fiscal plans on the 30th of October, so 3 months away from now. So that's a long time. Only 3 months ago, everyone thought that the UK election might be in Q4. So the world of politics can move a long time in 3 months. So I think it's best to think about it in different scenarios for now. So the sort of scenario where the Bank of England has to respond is that this black hole is filled by the deficit. The government borrows more to make the shortfall up. The Bank of England, in that case, may have to take some pause for thought. But it might not be this year, it might be next year. In the case where this shortfall is funded by higher taxes, or in fact stronger growth or just stronger revenues, and the overall borrowing doesn't change dramatically, then the Bank of England can probably continue as it planned. So there's still a long way to go over those 3 months, and exactly which scenario we fall into will probably determine where bank rate goes, particularly over 2025.
And so, Matthew, in the meantime, I mean, yes, the budget not coming until October, but the last fiscal planning, I suppose, the Bank of England will have been under the previous government. So, and we know they are price takers when it comes to the fiscal story. They just accept what the government gives them on that front, and that's the message we get. But does that really mean that they just keep their fiscal assumptions the same as they were under the Conservative government until we get the budget? Is that how the process works?
For the purposes of the forecasting, it's exactly how it works. So they take stated government policy, that the last system budget. They can provide scenarios around that, and they may do. They're going to use more scenario analysis, but in terms of what will be in the central projection, it's current stated government policy.
OK, well, we know the Chancellor's been pretty explicit about this, and we heard this on the Newsagents podcast. They report on this, that Rachel Reeves is going to, she did say, yes, we're going to have to raise taxes. And I know, look, we haven't had that solidified yet, but that was the line from the Chancellor. So as we look ahead to October, how are you starting to think about the prospects of higher taxes, whether that lands on wealth or capital gains, and how that fits into your models for the UK economy?
So we typically think about it in an aggregate sense and what that means for growth. So we take the whole fiscal picture and the whole monetary policy picture and sort of try and divine what that means for the overall restrictiveness of UK policy. Ultimately, where we think it'll go at the moment is growth of around 1% this year and then 1.25% next year. So we do see quite a pickup relative to 2023, where we saw the economy broadly flatline.
Matthew, thank you very much. Thanks for joining us. Matthew Swann, Senior Europe and UK Economist at BNP Paribas Markets 360. And we will bring you, of course, the Bank of England's policy decision later on during programming. And for our viewers in the UK, we'll have special coverage of the Bank of England's press conference. That's at 12:30 p.m. UK time. We'll have an interview with the Bank of England Governor Andrew Bailey after the decision today. Catch that at 5 p.m. UK time. And coming up on this programme, we'll be back to the aviation sector. We covered the Rolls-Royce story earlier on and the Wizz Air story. It's the latter we'll focus on. Wizz Air shares sinking after the company slashes its profit forecast. We'll speak to the airline CEO, Joseph Faradi, about aircraft availability next. This is Bloomberg.
Welcome back to the opening trade, 45 minutes into today's session. And it's a bit of a challenge picture across Europe. The benchmark is currently down 0.3%. Here in the UK, the FTSE 100 currently flat, but pressure going through in France. The CAC 40 down a full 1 percentage point. Autos is a drag, as is the luxury sector. Let's get to the earnings story then. A couple of big names, a number of big names, of course, reporting. We've been speaking to executives throughout the last few hours. We turn to another CEO right now because Wizz Air, and you can check in, you can see the price there, a massive hit for that stock, down 12% on the back of an earnings miss in the first quarter, but also importantly, the cut to the outlook for the year. Very pleased to say, for details on this and a reaction is Wizz Air CEO Joseph Faradi. Joseph, thanks for joining us. Talk to us about the details within these earnings. A number of analysts pointing out in their reaction, costs, costs, costs. What are you doing to address the cost impact for this business, and how do you see that picture adjusting in the months ahead?
Yes, absolutely. I mean, as you know, that we have been struggling with a number of supply chain issues. Most notably, our engines are impacted significantly. They are under inspections, and as a result, a number of aircraft are grounded. We have roughly around 20% of our fleet on the ground at the moment. It comes with significant cost, although some of it is compensated by the manufacturer, but it's still cost to the air system. The air traffic control situation has been miserable in Europe over the past few months, and we are not really seeing much improvement going into the peak summer. So we have to observe that as well. But with regard to the numbers we are reporting, I mean, most of these numbers are one-off. Particular to the current situation, like wet leasing aircraft in order to protect capacity against the engine groundings, and these costs will be phased out. So we're seeing that we are still in control of cost over the long run. We are certainly in control of our revenue, so the fundamentals of the business have not changed, but given the unpredictability in the current context of the operating environment has made an impact on us.
OK, there's a lot to unpack there. Let me start with the line. Then 20% of the fleet grounded. Part of that, you say, is down to the Pratt & Whitney engine issue. What is the time frame that you're looking at, Joseph, to get that resolved? What are you hearing from Pratt & Whitney on that front? What is the time frame you're looking at? When do you get that 20% back in the air?
Yeah, as you can imagine, this is like a daily process between us and the manufacturer. So we are reviewing the situation every day. This is a long cycle. This is going to take 2 to 3 years to completely get this issue behind us. We are now seeing some very slow but gradual improvements coming through. So we have 46 aircraft on the ground as we speak. We are expecting somewhat less next year, and the proportion of the grounded fleet will come down. But this is not an overnight fix. This is going to take years.
OK, so this is going to take years, which takes us back to the cost pressures, I suppose, Joseph, because one of them, as you've mentioned already, is the wet lease of aircraft, so leasing those flight-ready aircraft with crews attached to them, and that is costly. Do you think that that's been the right call, will continue to be the way that you manage this? Are you making any changes to the way you approach that cost?
Yeah, so basically this takes me back to like 3 or 4 months ago when the forecast of Pratt & Whitney on engine groundings was really bad. And at that time, we clearly forecasted significant capacity drops going into the peak summer. It has two issues, at least. One is that we would have been affecting a significant number of travelers already booked their tickets. Two, we would have been handing over established markets to our competitors. So we decided that we have to play strategic defense and make sure that we protect capacity going through the summer. The only available tool on hand at that time was wet leasing from other operators. That's why we decided to do that. In the meantime, actually, the situation started improving on the engine groundings, and on that basis, we decided to phase all these wet lease operations out by the end of the summer. So this is really temporary, one-off, and this is not going to affect the business structurally going forward.
OK, so even if the disruption and the grounded aircraft takes years to solve, the wet leasing, you're bringing that to an end by the end of the summer. That's an interesting point. On the wider story around aircraft availability, we've heard from Airbus. They've been warning of supply chain problems, delivery delays. What kind of delays are you discussing with Airbus at this point? Bring us up to date there.
Imagine our relationship with Airbus over the last 18 years and the years to come to be totally programmatic. So we have like a programmed aircraft delivery stream with regard to new aircraft deliveries. I mean, we have taken deliveries of more than 300 aircraft by now from Airbus, and we are planning to take another more than 300 aircraft in the next 6 or 7 years. So this is an everyday programmed event for us. So if there is delay, it is shifting things from left to right, but it is not like fundamentally disrupting the program or fundamentally disrupting the operations of the airline. So it is more like that whatever we are not getting delivered at the moment will get delivered kind of at the back end of the delivery stream, which now extends until 2029. So despite all the delays on the supply chain on the Airbus side, we are still very confident that the capacity what we need to drive the business forward will be available to us in the form of new aircraft.
Joseph, there's been some reporting that your plans to expand in the Saudi market, in the Indian market, have fallen through. Can you confirm if that's correct? And if so, which other markets are you looking in terms of that expansion?
Yeah, actually, it is not. So with regard to India, this is simply just a long regulatory process to make sure that we get all the designations and we got permissions to operate the routes. Actually, we are quite on track on these matters. It just takes time. With regard to Saudi, we continue to build our business in Saudi Arabia as an inbound carrier. What is suspended at this point in time is a potential airline creation in Saudi, given that the local regulator has not decided whether or not they would be licensing new airlines. But we are still committed to the market. Actually, we are achieving very good results. We're seeing that the market clicks very well for the products and services we bring to it, and we will continue to build the business. But we are, for the time being at least, not creating a local airline in Saudi Arabia.
OK, so that's an update on India, useful, and Saudi Arabia. What about the fare environment more broadly then, Yosef? So we've talked a lot about the capacity management story and how you're managing that and then what that is doing to costs. What about the demand side and fares? What's the market like? What kind of fares will the market accept?
Actually, we remain very robust relative to the rest of the industry. As you see in our report, actually, our unit revenue continued to rise, and we are expecting that to happen throughout the balance of the financial year. Maybe less so in the peak summer period, but certainly the second half of the financial year. So actually, we feel very comfortable with demand and the need for our services and products. But at the same time, we are a party to the market, and when our competitors report significant price cuts and unit revenue falls, and we have been seeing it pretty much every day nowadays. We are not immune, we are affected, and we have moderated our expectations with regard to the yield environment, but that doesn't mean that we are on the very same trends as our competitors. I mean, we are a very well diversified business. We operate 1,000 routes to 60 countries across 200 destination points. I think that gives us the ability to kind of offset some of the market weaknesses here and there with market strengths in other places.
How much transparency do you think you have on fares then as you push out to the rest of the year? Because we were speaking to one of your competitors, the CFO of Ryanair, saying, look, we're seeing that strong demand, but we are having to lower pricing. What is the transparency that you have towards the end of this year on fares, on ticket prices?
I mean, the transparency what we have internally in the system is, of course, we are seeing booking trends, how we are booked versus previous years, and we are up on every metric you can imagine on the revenue side. But again, when you look at the context of the operating market, it is not only down to the airline industry, but also it is across the board, across consumer industries. Everyone is pretty much reporting a softening of the revenue environment, which I guess suggests that inflation has been catching up with the consumer. Disposable income is getting increasingly squeezed and contained, and as a result, that starts affecting the marketplace for consumer goods and services. But again, I think Wizz Air brings in a fairly unique model to the market, being an efficient low-cost carrier that enables us to take advantage of market situations like this, where people are dropping off from high-cost carriers. We can capture them and build the franchise going forward, still within the current context of the market.
Joseph, thank you very much for joining us. Good to speak to you. Thanks for your time, Joseph Aradi, the Wizz Air CEO. Let's talk about the Bank of England, because that looms large on the agenda, doesn't it, Tom? We're going to be hearing from the BOE, a rate decision later on, followed by a press conference. And we could get the first rate cut from the Bank of England since the early days of the pandemic, March 2020. We remember that well, when the world went into lockdown and central banks went into policy overdrive, really. We're trying to stimulate.
Yeah, and our previous guest from BNP saying he actually sees 3 cuts from the Bank of England this year. Back in June, they said the line coming out was that it was finely balanced in terms of the decision. So we'll see how Andrew Bailey sits in terms of the mix as well, in terms of the breakdown of the votes on the MPC, where we know there is that division. The pound has done a lot of lift as well. It's a little softer so far in the session. You're looking at the pound at 127, down 0.5% in today's session. But since April, you've seen gains versus the US dollar of about 3%.
Yes, and that matters for the Bank of England, doesn't it? Because of imported inflation around energy products in particular. So we will certainly keep those topics in focus. We will be bringing you the Bank of England policy decision later today. For our viewers in the UK, we'll also have special coverage of the press conference at 12:30 UK time. We'll then bring you an interview with the Bank of England Governor Andrew Bailey after the decision. What context does he add to that decision? Catch that at 5 p.m. UK time. Also, Barclays CEO will be joining the surveillance team shortly. This is Bloomberg.